Good evening, everybody. Sorry about that. It normally says recording in progress, and it didn't do that. So I wanted to make sure that it was indeed recording, and it is. So good evening, welcome. Tuesday the 14th. Yesterday was a holiday, so we're broadcasting tonight on a Tuesday. So I'm going to go ahead and jump right to it tonight. I'm going to go ahead and turn off my video and save that bandwidth there. Tonight, what we're going to be doing is I'm going to be completing the factor market, the FMA module, and then I'll be doing some practice problems at the end. So you're going to want to stop, pause, and rewind and do these practice problems here so that you'll know if you got the stuff down here before we go. We're doing really, really well for time as far as it's concerned here. But we're going to go ahead and get this factor market module done tonight. So here we go. Let me go ahead and start sharing my screen. We will jump to it here. So last week I showed you how to draw a pro-competitive factor market and a monopsony. And we'll come back to that stuff in a little bit. We'll do some of that drawing stuff here, more drawing stuff in a little bit here. But for now, what I want to do is I want to jump into something that is definitely heavily tested on the AP exam, and that's the least cost rule and the profit maximization rule. So going back to Unit 1, the very first module in here, we learned about the law of diminishing marginal utility, not the law of diminishing marginal returns. Law of diminishing marginal returns has to do with production. The law of diminishing marginal utility had to do with consumption of a product and how as you consumed a product, your satisfaction, your utility, your satisfaction diminished. You eat the first donut, it's really good. Second donut, not as quite as good. Third donut, definitely not as good. By the time you get to about the fifth or sixth donut, you're almost getting yourself sick. That's diminishing marginal utility. And then we went from there and we said, okay, well, there's this utility maximization theory that said that when you are consuming or buying or whatever two different goods, you should consume them so that the margin utility per dollar of each of them is the same. If you'll remember going back to that first unit, we use this formula up here. We do the margin utility of, say, good A over the price of good A should be equal to the margin utility of good B over the price of good B. And what we said is that if the additional satisfaction per dollar of good A is greater than the additional satisfaction, marginal utility, additional satisfaction per dollar of good B, then you should buy more of A and less of B. And when you did that, the margin utility of A would go down, and eventually these two would then become equal to each other. Okay, so what we're going to look at now for the least cost rule is that this exact same concept, but we're not dealing with utility. Okay, what we're trying to deal with here is we're trying to decide what is the optimal combination of resources. The two resources we usually deal with here is labor and capital. How many workers and how many machines. And that's the idea here. And you can vary that amount. You can have more workers and less machines. You can have more machines and less workers. One excavator digging a big giant hole with one worker, or you can have 12 workers and no excavators, or you can have, two excavators and 7 workers, whatever. There's variation you can do, but what is the optimal combination there? And there's two different ways of looking at it. The first is to look at the least cost rule. Okay, now obviously the least cost rule is to shut down and have 0 workers and zero capital, but we're ignoring that. Okay, the assumption is we have two resources. We're going to do labor and we're going to do capital here. And what we're going to do is we're going to look at the marginal product. And if you'll remember, marginal product is the same thing as marginal physical product. We use those terms interchangeably, but for the most part, let's talk about just marginal product. It's easier. That's what we've learned and what we use the most. We're going to look at the marginal product per dollar. So we're looking at the marginal product per dollar of labor, and we're going to compare it to the marginal product per dollar of capital. And then you follow the exact same rule here. If you've got the marginal product of labor over the dollar price of labor, and that's usually wage, is greater than the marginal product of capital, and we use K for capital because C is cost, divided by the price of capital. And it's okay if you use C there. So if the marginal product per dollar of labor is greater than the marginal product per dollar of capital, then you should buy more labor and less capital. Okay, get rid of some of your capital, sell some of your capital, and buy more labor, right? And when you do that, the marginal product of labor will begin to diminish, and eventually these guys are going to be equal. When they are equal, you are achieving the least cost rule. The least cost rule is where the marginal product of labor over the price of labor is equal to the marginal product of capital over the price of capital. When you're doing that, you're meeting the least cost rule. Okay, now how do they test this? There's a bunch of different ways they can do this, but let's just a simple one here. Let's assume the marginal product of labor is 20, the price of labor is 1, the marginal product of capital is 10, and the price of capital is 1. What should you do? Okay, to achieve the, and it wouldn't just say what would you do, it would say, to produce in the least costly way, or something like that. Well, what you do is you just set these, put your formula out. And remember, if they ever say to calculate it, you have to show the formula. So always show the formula if it tells you to calculate, and your formula is this. Okay, now we just plug in the numbers. We say 20 over 1, right, should be equal to 10 over 1. Well, it's not. In fact, 20 over 1 is greater than 10 over 1. So what do? The answer is buy more labor and less capital. Why buy more labor? Because your additional production per dollar is greater than the additional production per dollar of capital. So you buy more labor. But if you're going to buy more labor, you don't have an infinite amount of money or funds. Businesses don't have an infinite amount of money or funds. So you have to then go buy less capital, more labor, less capital. All right. Here's another way they can do it. They could say the marginal product of labor is 25, the marginal product of capital is 20, the price of labor is 100. What's the price of capital? Assuming that we are meeting the least cost rule. So again, marginal product of labor over the price of labor has to equal the marginal product of capital over price of capital. Since they're saying calculate it, doesn't say that, but if they said calculate, we'd have to plug in all the numbers and give the formula. So it's 25 over 100 should equal 20 over X. And you solve for X, and X will give you the price of capital. And when you do that, you find out that X is equal to, what is that? 80. Yeah, so X will be equal to 80. Okay. Anyways, second rule they may test you on is called the profit maximization rule. Okay, this is where a firm is trying to maximize its profits. Now, in the product market, we know that's they produce, where all firms produce, where MR equals MC, and when they're doing that, they are maximizing their profits. Here we're talking about not profits of production, we're talking about profits from hiring the right combination of labor and capital. All right, so what we need to do here is a couple of little steps we need to do to figure this out. Whenever we're talking about perfect competition, we know that marginal revenue product is, to calculate marginal revenue product, it's the same thing as marginal product of the resource times the price, okay, the price of the product. When you do that, you get the MRP. That's additional revenue that's coming in. So in other words, if you hire me and I produce 10 more units and you're selling those units at $3 a piece, then my marginal revenue product, I'm bringing $30 more into the cash register. This was covered at the beginning of this unit, okay? So once you've got that, what we can do, the next step we can do is we say, okay, we now know how to calculate MRP, and we know that all firms hire where MRP is equal to MFC, okay? And MFC is the same thing as wage. So that's the same thing as wage, and it's also the same thing as the price of labor. Okay, so let's just, you can kind of see where we're going with this. Back here, when I was talking about like the price of labor right here, it's the wage, and it's MFC, it's the marginal factor cost. Okay, so what we can now do is we can take this formula right here, MRP equals MFC. We can change it to MRP is equal to the price of labor, because MFC is the same thing as the price of labor. So we've got MRP equals the price of labor. Now we're going to divide each side by the price of labor. And when we do that, we're going to come up with our new formula. This is the profit maximization rule. Okay. If you will hire where the MRP of labor over the price of labor is equal to 1, you are then meeting this rule right there, MRP equals MFC, and you are profit maximizing. You're hiring, in this case, labor at the right quantity to profit maximize. MRP of labor over price of labor should equal to 1. That's the key. It just has to be equal to 1. This makes it real easy here. Okay. If we throw in a bunch of other things, we throw in capital, which I did as C this time instead of K, because that's acceptable also. And I did whatever. Maybe there's a third resource you're buying. As long as they're all equal to 1, then you're good to go. If any of them happen to not be greater equal to 1, so in this case, the marginal product of labor over the price of labor is greater than the others and not equal to 1, you would hire more of this, and therefore you got to hire less of the others until you get them all equal to 1 again. Okay. Usually when they do this, they're only going to give you 2 things. Okay. And the key is that has to equal 1. Okay. Let me give you an example here. So this is going to be a fairly long, not fairly long. It's going to be 2 different questions asking 2 different things here. Assume a firm buys resources in a perfect competitive factor market. The marginal product of labor is 50. The marginal product of capital is 80. Price of labor is 100, and the price of capital is 160. So the first thing I want to ask, is this firm operating in an efficient manner? Efficiency has to do with least cost. Is it producing in the least costly manner? So the formula we need to use here is the least cost rule. Don't worry about number 2 yet. We'll do that in a minute. Okay, the least cost rule. Okay, so what you do is we know the marginal product of labor over the price of labor should equal the marginal product of capital over the price of capital, blah, 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 blah. 50 over 100 equal to 80, 160. They actually are equal. So yes, this firm is hiring capital and labor in the least costly way, right? But what in reality, there could be multiple least cost ways of hiring and these 2 resources here. So then the next question says, are they, and the next question says, what would be the market price of the product for the firm to be profit maximizing? So notice here we've got the price of labor and we've got the price of capital, but we don't have the market price. Very good question here. They can ask this, okay? So how do we find out the market price? Well, we need to go back to the things that we know here. All right. First thing we know is that the marginal revenue product is marginal product times product price. There it is. That's what we're looking for right there. We're trying to find that guy. Okay. So, well, let's see. We know that marginal revenue product of labor over price of labor has to equal 1 because we told you that they're profit maximizing. So there's the formula for profit maximizing. Okay. Then we also know this formula right here, that marginal product times price is equal MRP. So we can rewrite this formula right here, which is profit maximizing formula, as marginal product times price. And again, this is what we're trying to figure out right here, over the price of labor should equal 1. Well, we know the price of labor. The price of labor is 100, right? We know the marginal product is 50. So what we've got is we got 50 times P, which is what we're trying to solve, over 100 should equal to 1. When we do our math voodoo, which is algebra, and solve for P, we find out that P is equal to 2. Okay, so very interesting question. They've asked this a lot on the multiple choice, like pretty much every year a multiple choice question comes up on this, where you have to do this little kind of math to get there. So there you go. Again, stop, pause, rewind. If you didn't follow this the first time through, stop, pause, rewind, and watch it again so you got it down. Here's another multiple choice type question. This actually came from College Board stuff here. For a certain firm, the marginal revenue product of the last unit of labor is 60. The marginal revenue product of the last unit of capital is 100. Which the following combinations of factor prices would be necessary for the firm to maximize profits? So what you have to know here is that the marginal, if we go back, let me just go back to it here. Okay, we know that the profit maximization rule is the marginal revenue product of labor over the price of labor as equal to the marginal revenue product of capital over the price of capital equal to 1. The key to this is the equal to 1. So this makes it real easy here. So the marginal revenue product of labor over the price of labor has to equal the marginal revenue product of capital over the price of capital equal to 1. Well, let's see. So it's going to be marginal revenue product of they give you that one, sorry. So it's going to be 60 over the price of labor should equal to 100 over the price of capital equal to 1. Well, gee, 60 over PL has to equal 1. So what's the price of labor have to be? 60. right? So that right there, you didn't even need to be able to do capital to get it right, right? But let's make sure. 100 over the price of capital has to equal 1. So what does this have to be? Price of capital has to be 100. Therefore, your answer is E. Here's another one. A perfect competitive profit maximizing firm will continue to hire units of an input as long as what? This one's a tough question. Okay. The answer here is C. Okay. As long as the value of the marginal product of the input, the value of the marginal product of labor is the same thing as its MRP at a specific point. Okay, so let me show you what I mean here. If we have a downward sloping demand, which is your MRP, so you've got all these possible MRPs, right? At a specific point, at a specific quantity, right here, we can get a specific MRP. That's the value of that quantity of workers at that quantity. That's the value. We call that the VMPO. Okay, the value of the marginal product of labor. Okay, and that's what they're asking for here. So you're going to continue to hire as long as the marginal product per dollar is higher. Okay, the value of the marginal product of the input exceeds the price of the input. Okay, because we hire where MRP is equal to MFC. I don't know why I did this one up here. This one is actually wrong. It's not wrong. It's just a different way of going at it. If the marginal of your product or the value of this marginal of your product is greater than the price you're paying them, hire them. So if they're bringing $15 more into your cash register and they want to get paid 10, hire them. Right, and that's all that is. Tough question. Read through it and see what the other answer choices are. I'm giving you this because I know when they ask stuff like this. Here's the next one. Assume that the last worker of a firm hired produces 60 additional units. That's a fancy or a simple way of saying the marginal product of labor is equal to 60. And the last machine is 600 units. So the marginal product of capital, that's an L right there, is equal to 6,000. The wage rate of labor is $12, and the rental cost of capital is 1,000. So what are we looking at? In order to minimize costs, so we're looking at the cost minimization, which is the marginal product of labor over the price of labor, has to equal the marginal product of capital over the price of capital, not equal to 1. That's profit maximization rule. This is least cost rule. So what do we do here? We plug in the numbers and we find out that 60 over 12, I've already did it on the next page, we should do that. We find out that 60 over 12 is actually less than 6,000 over 1,000. So what do? You hire more capital because 6 is greater than 5. So you hire more capital, but if you're going to hire more capital, you also have to decrease the amount of labor. So the answer is here because you're going to hire more capital, but you have to decrease the amount of labor because you only have an X amount of money. Okay, so that's how you use those guys. That's how you use the least cost rule and the profit maximization rule. Different numbers. They can give this to you in a chart and make you calculate some of these things, make you calculate marginal products. They can give you the price. There's all sorts of different ways of doing this. So be prepared for anything they do as far as just make sure you have those two formulas memorized. All right, let's talk about minimum wage here. Minimum wage is where the government comes in and puts in a minimum wage. In other words, everybody has to be paid more than that, equal to or more than that. So what we want to know is how does it affect a monopsony? Okay, we're going to go to a monopsonistic labor market. We're going to see how it affects a monopsony. Now, one thing I want you to know here is when they talk about minimum wage, always assume that it's what we call effective. In other words, the minimum wage is higher than the current wage rate. Right now in Georgia, the minimum wage is lower than what people are getting paid. So it's actually what we would call an ineffective minimum wage. But ignore that. Never assume it's ineffective. Always assume that it is effective. It's working. Another term they might use is binding. Okay, in other words, you have to go by it. the firms have to go by it. In other words, the minimum wage is higher than what the market wage is. Okay, so let's see what happens. So let's suppose that this is a monopsony here. And right now, this monopsony, ignore the minimum wage, is going to hire QM workers. And because we go where MRP equals MFC, right? That's where they go. And they're going to hire Q workers. And we get the wage rate always comes from the supply curve. So the wage rate would be WM. So right now, this firm would hire QM workers and pay them WM. If we put the minimum wage down here, well, that wage is below WM. So that minimum wage is ineffective. It is not a binding wage. So what would happen is the firm would just totally ignore it. Okay. But what if they put the minimum wage higher? Suppose they put it between, let's say, this point here and this point right here. Okay, between those two blue dots. And why did I pick that? Because I'm actually gonna work my way up. I'm eventually gonna go into this range and then again into this range here. I'm gonna show you what happens at each one of these ranges here. Okay, so what we do here is the minimum wage. The way you got to think about this in your mind is the minimum wage becomes the MFC. Okay, I can hire as many workers as I want at that wage, so the minimum wage becomes the marginal factor cost. If the minimum wage is set at, say, $15, then I can hire as many workers as I want at $15. Okay, so what we do is we just start going across this dude here. And we say, okay, here's my minimum, here's my wage. MFC is 15, MFC is 15, MFC is 15. I hit the first line. First line I hit is MFC. Well, is our rule where you hire where MFC equals MFC? No. You hire, your rule is you hire where MRP equals MFC, right? So we ignore that first line you hit and you keep on going, you keep on going, you keep on going. Now you hit a line. The next line you hit is the supply curve. Is my rule to hire where MRP equals supply? And the answer is no. So what you would think there is you would think keep on going. The problem is if I go further, now because of this upward sloping supply curve, in order to hire another worker, I've got to give them a raise and all previous workers a raise. So my MFC actually goes to this point and then it jumps up straight up to this point right here. So my MFC is actually this horizontal line. And then if I want to go beyond that, it jumps up to the original MFC, right? So it actually does cross the MRP, I'm trying to find a different color, right here. So that's where we hire. So we're going to hire QL workers and we're going to pay them $15 or what the minimum wage is. I'll say that as minimum wage. Min wage. So again, think of the minimum wage as the MFC, the additional cost of hiring a worker. Horizontal line, ignore when it hits the MFC because you don't hire where MFC equals MFC. Hits the supply curve. Now you don't hire where MFC equals supply, but to go beyond that point, to go keep on going beyond that point, we now have to give everybody a raise. And so the MFC jumps up here. So it hits MRP at that point right there. So we hire QL workers. Okay. What if instead we wouldn't even hire? Same concept here. What we do is we just follow this guy across. First thing we hit is MFC. Ignore it. You don't hire MFC equals MFC. Next thing we hit is MRP. Yes, you hire where MRP equals MFC. So you hire QL workers. What if we raise it even higher? Okay. Minimum wage is the MFC. First line it hits is the MRP. They would hire QMIN workers. All right, so really that first one's the hardest one to do here. Now let me show you this. This is kind of interesting. So how many workers get hired actually depends on where, how high the minimum wage. Okay. In fact, what it does is the quantity actually goes like this. Right? Oops, that should be a straight line there. It's really bad. Okay. It goes like this. Wherever that minimum wage hits, that's where it is. So if the goal of the government here is to get the most workers hired, they should put the minimum wage right there. Because if they put the minimum wage higher than that, then what's going to happen is the firm just follows this guy this way and then it goes back this way. If they put it high enough, you can actually have a lot of people who will lose their jobs, right? Now, the cool thing about this is what is significant about this point right there, that big green dot? What's significant about that point? And that's that if this were a perfect competitive market, that's where the supply and the demand curve intersect. That's where a perfect competitor would hire. So if you had a situation where you have a huge monopsonistic market out there, which we do not, then they would want to put it right here. They'd want to put minimum wage right here at Q most, and you get the most workers hired, which would mimic perfect competition. Now, again, we don't really have a huge monopsonistic market. A lot of people argue teachers are hired in a monopsonistic market because if you want to work in the county you live in, you can really only work for that school system. Professional sports, which is ludicrous because they get paid way above WM, that sort of stuff. Coal mines, maybe like a coal town, if you're a coal worker, you can only work for those guys, things like that. But anyways, so that's minimum wage and how it affects is affected on that stuff. What I'm going to do now, I've got about 30 minutes here, is I'm going to work through this nice long problem here. Okay, so this is a practice problem. What I would suggest you do is stop the video and try to work through this problem. Try to do all 9 of these problems. If you can do this, then this is pretty much everything they've kind of have asked in the past on free response tests. There's a variation of things like that. They might make you draw things and things like that, but this is kind of a variation here. So what I'm going to do is I'm going to work through each of these questions one at a time. Okay, so go ahead and stop the video right now, work through all 9 of these videos, then start it when you're ready. So here we go. I'm going to work through it now. Assume the firm produces output with 1 fixed input, capital, and 1 variable input, labor. The firm can sell all of its output it produces at a market price of $3. So this is in the product market. The price is $3, and hire all the workers it wants at a wage rate of 11, and it has a fixed cost of $10. It faces the following production schedule. So this is the production schedule right here. Okay, this is number of employees, and this is total output, which is the same thing as Q, quantity of output, right? This is the same thing as quantity of labor. Okay, so the first thing is what market structure does the firm sell its output? How can you tell? Okay, the answer is it sells its output in a perfect competitive product market. And the reason why you know that is it tells you that the market price is $3. It can sell as many units as it wants at $3. It's a price taker that makes it perfect competition. Okay. Number 2 said, in what kind of market structure does the firm hire its employees? How can you tell? And they wouldn't say, how can you tell? They would say, explain on the AP exam. They would say, explain. I probably need to go back in and change it to say, explain. The answer, again, is a perfect competitive factor market. Why? Because they can hire as many workers as they want at $11. So they are wage takers. So it's a perfect competitive factor market question. Okay, ignore the red for now. At what quantity of workers does the diminishing marginal returns first occur? So explain using numbers. To do this one, what you had to do is you had to solve for marginal product. Okay, well, marginal product is the change in total product, which is quantity, divided by the change in quantity of labor. So it's 7 minus 0 divided by 1 minus 0. Now, all these go up by 1, so we can ignore the divide by the bottom number because the bottom number is going to be 1. So 7 minus 0 is 7. 21 minus 7 is 14. 31 minus 10. 31 minus 21 is 10, and so on and so forth. So where does diminishing marginal returns first occur? The answer is after the second worker or with the third worker, because it could actually have occurred somewhere in between here. So when you do this, you'd want to say, the question says at what quantity? I would actually answer it as after the second with the third, because we don't really know it occurred with the third. It might have occurred with 2.1 workers, but they would give it to you if you said with the third worker. But anyway, now, interesting thing is then says explain with numbers. This is very important that you do this right. You can't just say because marginal product went from 14 to 10. Okay, you have to tell them that it went from 7 to 14, so it was going up. Then it went from 14 to 10, because otherwise you could say the fourth worker. The fourth worker went from 10 to 3, right? But no, that's not where it began. It began because it went from 7, 14, so it's still going up. Then it went down. So you got to make sure you use all the numbers there. First worker is 7, second worker is 14, third worker is 10. Therefore, that's how you know diminishing marginal returns occurred with that third worker. Very important you word that right. Given the production information, use marginal revenue product analysis to explain how many workers the firm should hire. Okay, well, we know that all firms hire where MRP is equal to MFC. The MFC is 11. Okay, so the MFC is 11. So we want to hire where MRP is 11, right? So what we have to do now is we have to calculate the marginal revenue product. How do we do that? This is perfect competition. So marginal revenue product is marginal product times price. Marginal product times price. The marginal product is here. So it's just 7 times, what's the price of product? I forgot. 3? 7 times 3. I could have done the math. 7 times 3 is equal to 21. 14 times 3 is 42. 10 times 3 is 30, and so on and so forth. So now you calculate the MRP. Now we hire where MRP equals MFC, so you want to go where it's equal to 11. So will we hire the first person? Yes, because they're bringing $21 into the cash register and we're selling them for 11. Hire the second person. They bring in 42, we're paying them 11. Hire the third worker. That, by the way, I said we hear you're selling it for 11. No. You're selling the product for 3. That has nothing to do with it. They're bringing $21 in and we're paying that worker 11. You hire the second worker, you hire the third worker. You would not hire the fourth worker, because the fourth worker's he's bringing $11 in the cash register and you have to pay him 11. So where do we stop? We stop at 3 workers. Okay. Now, but they're not equal, right? I thought we said that we always hired where they're equal. Well, in real life, they can't always be equal. So you would hire where you try to go where MRP equals MFC. And if you can't make it equal, then you always stop where the MRP is greater than the MFC. Okay. And same rule as we learned way back in the product market. You always try to produce where MR equals MC. And if you can't get them equal, then you want to stop where MR is greater than MC. Never want your additional cost to be bigger than your additional revenue. Same concept here. It does say explain using numbers. So what you'd have to do is you'd have to say 3 workers, because that's where we stopped. And you'd have to say you want to hire where MRP equals MFC, but you can't. So since MRC is 11, you would hire the first one because 21 is greater than 11. You would hire the second one because 42 is greater than 11. You'd hire the third one because 30 is greater than 11. But you would not hire the fourth because 9 is less than 11. So you kind of have to work through this whole thing and tell them why you stopped, where you stopped. Okay. Next one, number 5. Based on your answer in number 4, how many units of the output will the firm produce? So, well, we said we're going to hire 3 workers, and those 3 workers are going to produce a total of 31 units. So the answer is 31. Okay, so all you do is you just go 3 units. The answer is 31. 3 workers, 31 units. All right. At the level of output you identified in number 5, calculate the firm's profit or loss. Okay, so well, let's see. We're going to produce 31 units. So our total revenue is going to be 31 units. We're selling those dudes at $3 a piece. Why $3 a piece? Because I told you it right here, or they told you it right here, right? What's our total cost? Well, our total cost is we're hiring 3 workers, right? And we're paying those workers $11 a piece is equal to 3 workers at $11 a piece. That's our variable cost, but they threw in a little trick here, a little tricky thing. Fixed costs are 11. So we have to add also, this is our variable cost. We have to put the fixed cost is equal to 10. So total revenue minus total cost, because remember, total cost is fixed cost plus variable cost way back in the earlier units. So it's 33. So it's 31. Anyways, here's the math right here. It's not total revenue 93 minus 43, which is the 33 plus the 10. So the profit is $50. So the answer is 50. You had to show your work. So you had to actually give all of these formulas. Okay, if you didn't do this, take 17 points off, maybe 18. I don't know. Your total revenue, you had to show total revenue is price times quantity. Total cost is best to do variable cost and fixed costs like this, or you could have just done number of workers times wage plus the fixed cost. But you need to show this, and then you need to plug in all the right numbers here and here and here and here and up here, plug in all the right numbers and come up with $50. Next one says, at what wage rate? No, I'm sorry. What is the maximum wage rate the firm would be willing to pay the fifth worker? We already kind of did something like this. You calculated the MRP for the fifth worker is $3. So what's the maximum you pay them? $3. Okay. Explain. You always hire where MRP equals MFC. And I said here MRC. Remember, MRC and MFC are interchangeable. Okay, I kind of did that on purpose. They're interchangeable. The AP exam is most likely going to use MFC, but you might read it in a book somewhere. You might see it somewhere where it uses MRC. The bottom line is you're going to hire this. The most you pay them is $3 because they're bringing $3 in the cash register, which is the MRP. So the most you pay them is $3. If the market wage rate fell to 9, what would happen to the supply of workers in the firm? Explain. Okay, the idea is the supply of workers would decrease, right? Because the wage rate, which is supply equals MRC, comes from the market wage rate. If you'll remember, let me just draw it here. It's easier. It's always easier to draw a graph. This is quantity of labor. This is the wage rate. There's our supply curve, right? And this was the quantity of labor that in the market. And this was the wage rate. Let's say the wage rate was, what was it before? 11. The wage rate was 11. So this was actually 11. Stop. We're going to stop. 11. Okay. And so over here, this wage rate, trying to go too fast. Let me slow down here. This wage rate was 11. So the MFC equals 11, which is equal to the wage rate. You had a downward slope of demand curve, which is your MRP, right? And this is the quantity of labor. And that quantity of labor we found out earlier was, what do we say it was? The first workers, you're going to hire 3 workers. So that quantity of labor here was 3. And like I say, they can make you draw this graph. That would be a fair game question. So take a look at this graph. Everything look good? And the answer is no. It doesn't look good because there's a couple things I did. One, you need to label your axes, W and quantity of labor. And I erased that right there. That's wage rate. Okay. Now, what happened in this question is the wage rate fell. Well, as soon as the wage rate falls this way, then this guy's going to go down this way. It fell to 9. So the supply of labor, which is also the supply of labor, falls. So your MFC prime is equal to 9, which is equal to W prime, which is equal to S prime. The wage rate, the number of workers decreased. That's all that's asking. Okay. At the new wage rate of $9, would the firm hire more, less, or the same number of workers? Explain. This one's a tricky question because you would think that, well, let me just show you on that. Show on the graph here. Notice that it intersects further to the right. So you would actually hire more workers. And in fact, we know how many workers they would hire. If you go back to this, they would hire this one, this one, this one. They would actually hire 4 workers now. So they would actually hire 4 workers instead of 3. Okay. The thing that's tricky about this is you'd think if the supply of labor went down, you would have less workers. It doesn't mean that we can't hire more. There's just less workers available to work, but there's always workers out there. You can find the workers. We have that perfectly elastic supply of labor, so we can hire more workers. So the answer is more, and this is explained. And the best way to explain this one is you would literally say, since the wage rate went down to 9, we would hire the fourth worker where before we were hiring 3. So that's probably the best way to explain it. All right. What are your questions? All right. So that's all I've got for you tonight. Have a great evening. And next week we move on to the next unit. So I'm going to go ahead and shut down here.